Live at the CME Group in Chicago. Richard Regan of ProTradingCourse.com. Richard develops and executes trading strategies, monitors markets and positions, and has personally trained over 300 traders. Also with us is Rod Smyth. He's the chief investment strategist at Riverfront Investment Group. He told us in April that stocks could retreat if market sentiment became super optimistic. By late April, stocks began to fall, in part because of the erupting Greek credit crisis, erasing much of investor optimism. And last month, Rod said stocks were clearly in a correction. So, Rod, let's start with you. Are stocks clearly in a correction? Can that turn around? Is that what we're going to see coming in the next couple of weeks?
I don't think so. I think we're still in this correction, and really, I've started to call it a decision box. And what I mean by that is
they always are.
Stocks, I think, are going to trade between 1050 or so at the low end and 1150 or so at the high end through most of the summer, because we're all trying to figure out, is 2011 a double dip or is it a continuation of the growth story? And until the markets can make up their mind about that, I don't think they're breaking out of that box.
Hey, Richard, let's bring you into this. I mean, what do you think in terms of, looking out to 2011? Still a long way away, or maybe not so much. But, I mean, is it a double dip, or do you think we'll see a continuation of the growth story?
Well, I think 2011 is a long way to look out. Here on the floor, we're doing a lot of intraday trading. For us, it looks like this summer may be lower volatility with a slow grind higher. This financial reform bill that passed today, you can see all the financial stocks rallying, and I think the rest of the market will rally off of that at least next week, or maybe even throughout all of July when we get into earnings season.
I wonder, Rod, what do you think we need to see here to really turn things around? Or can we see something to turn the economy and the market around? Or do we just have to sort of wait through the pain still?
I think there is. I think we're actually going to get it. And Richard's right. Earnings season. So what do we know? We know that there's been a soft patch has appeared in the U.S. You see that in the retail stocks very clearly. And we know that Europe is now going into a period of fiscal retrenchment. In other words, they're raising taxes and they're cutting spending. And that means that we're all worried about second quarter earnings. If second quarter earnings come out better than expected, I don't think they're going to. That would give the market a lift.
All right,
but if they confirm the gloom, then we're going lower in the short term.
Back to our roundtable. Rod, I want to bring you into this. We've got G20 going on this week, and actually a couple of big meetings by world leaders up in Canada. Anything significant that you think could come out of that meeting this weekend?
I think what is coming out of it, and I'm very aware of this because I just spent 10 days in the UK, which is my original home, and what's coming out of it is that the Europeans and the U.S. have a completely different view as to how to continue the economic story. The U.S. is saying, look, rates are low, we're not being penalized, let's keep spending, let's keep this growth thing going, and the Europeans are saying time to cut back on the fiscal side. And I think the markets are really reflecting that. While the U.S. is kind of in the middle, Europe is doing really poorly, and I think will continue to do so. But if you look where the growth is, Asia, China, Latin America, the emerging markets have really had a good run relative to the rest of the world in the last few weeks, and I think that will continue.
Rod, it's Dominic here. Speaking of, austerity has been this word we've been tossing around for a long time here now.
Yes.
It seems as though the U.S. is the only one not adopting austerity measures globally. Even China letting their currency start to appreciate a bit to try to slow down their economy. What's going to happen here in terms of the shift of capital around the world? Is it going to stay with emerging markets, or do we say that because the U.S. is still spending all kinds of money with the printing press on, that the U.S. is going to grow more?
No, I think the money, the capital is going to be going to the developing world and then get recycled back to the U.S. as those folk buy our treasuries. But I think what you want in this environment, the developed world is still in the grip of lack of growth and deflationary forces. So I want to invest in countries that have a growth problem, i.e. too much growth. That's a good problem to have in this environment. And so I like China, I like India, I like Australia, I like Canada even, I like the resource areas. Because I think that's where the secular growth story is, and I'm very worried about Europe because I think if they do too much austerity in a weak environment, you're going to see negative numbers for European growth next year.
Hey, Rod, it's Adam Johnson. Let me jump in. You didn't mention Australia, but certainly if you're talking China and you're talking commodities and growth, I would think that's part of it, no?
no question. I'm a little uncertain with Australia just recently with some of the politics that's going on there, but that has been very much on our radar screen. We've been playing Canada more than Australia. What we really like, actually, are some of the countries that are going to feed off China's growth, so Korea and Taiwan. As Chinese wages go up, they're going to need to spend more on capital equipment. The U.S. benefits from that. The only country I like in Europe is Germany. I think at euro parity, Germany is going to be very efficient.
Richard, let me bring you back in here and ask you what you've seen of the Russell rebalancing today. I mean, we always talk about how much volume this day brings and how much volatility it brings. What did you see as far as the action in relation to that?
Not quite as much as you'd anticipate. You know, in years past on the Russell rebalancing, we've seen huge influx of volume, and it's been fairly consistent throughout the afternoon session. Today, there's been a few pockets here and there where big size comes in, but ultimately today was the financial regulation reform bill, and that's really what caused these financial stocks to move higher. A lot of fear going into the weekend with such a big sell-off this week, people not wanting to hold their lungs and not follow these financials higher is what caused us to close around unchanged and not up too much on the day. But ultimately, I think that people are looking at it as the Russell rebalancing is just not having the impact it used to because everything's become so efficient, and we just didn't see quite the volatility we were anticipating down here today.
Richard, it's Dominic here. I mean, from a trader's perspective, you've trained a whole bunch of these guys down there on in the pits on the floors and whatnot and at their home computers. What's going on here? We're below the 200-day long-term average for the market, and the market keeps on trying to grind lower here. Are you seeing anything from a charts point of view or from a trading strategy point of view that our viewers could say, okay, well, this might indicate a direction going forward?
Well, I'll tell you, what we've been looking at primarily is ever since the euro got back above 120, we've been watching for strategic places to get long in the stock market. Additionally, we're watching gold. Gold has been a huge winner in the sell-off in the stocks, and if you watch, when the stocks rally, you see gold rally as well to some extent. So gold has been relatively strong. We think there's a lot of speculation pushing it higher, and it could be primed to go even further right now. So we think any continued sell-off in the stocks, and we're looking to get long gold. And of course, if the euro continues higher, we're still thinking it's a value play. I mean, we've been wrong a few times on this S&P on the way down, but we still like the idea of if the euro's rallying, we think the stocks will be strong.
You know, if we're not all reg reformed out, I want to get back to. Oh, actually, never mind. Rod,
I was going to say I would just first for the point of taking the other side. I think the euro is rallying temporarily, but I don't think it's good value. And if you have European economies flat on their back, the euro is going to be the one thing, the one escape valve that'll create some growth. But it's got to go down to 110, I think closer to parity before that really happens.
Well, let's talk about reg reform for a minute. I am curious, Rod, if you are seeing any opportunity in financials right now, because we have had some analysts come out and say, you know, since this wasn't as bad as expected, you should buy the bank stocks. On the flip side, you're looking at second quarter earnings season, and what are you expecting for the financials specifically on that front?
Well, forecasting financials earnings is, if it was ever easy, is now, you know, increasingly difficult because you just don't know how much trading and so forth that they're doing. But the way I basically look at this group is I don't see it's a group that you want to short because the news is out, the yield curve is positive, they are in a broad restructuring mode. But these companies are going from having a wonderful franchise to a much more difficult one, much more government constrained. If they make money, does the government keep kind of tax it? So I think banks and financials are a group you just mostly ignore.
Basically turning, I mean, we had one guest on earlier, Michael Arenstein, who said they're turning more and more into just utilities.
Well, some of them
Which is the aim, isn't it? Which is the aim, really, of reform.
For the time being. And, you know, what we need these folk to do from an economic point of view is lend. The challenge is that the consumers and the corporate sector are deleveraging. They just don't want to borrow. The only people who want to borrow are people that the banks don't want to lend to because the credit risk is bad. So what they're doing is they're basically playing the yield curve, borrowing short and investing in treasuries, which is helping keeping the treasury market low.
Hey, guys, we got about 30 seconds left here. Richard, what are you kind of keeping an eye on for next week? And just be quick if you could.
Well, I got to say that the financial sector, to me, I have to disagree with what Rod is saying. While I certainly respect his opinion, I believe that the financial sector is going to be a nice rally. I like Citibank, I like Bank of America. These stocks that don't have quite the big brokerage arm and prop arm like Goldman Sachs, I think they're really going to rally. As I think the Congress may have missed a mark on this financial reform bill.
I don't know, Rod. You got 10 seconds. You want to come back there on that one? But you got to be quick.
Sure. And I think the big thing with Richard and I is we have very different time frames.
Exactly.
But no, I think what I'm looking for from this market is, can it break decisively back up above the 200-day?
All right.
If it can't, you've got a position for a lower market ahead.
All right, Rod, Richard, thank you so much, guys. Have a great weekend.